Ever feel like you're just drowning in information, trying to get a real handle on complex stuff? Welcome to the deep dive. We try to cut through all that noise, give you the core insights you need on topics that, well, they might sound a bit niche, but actually have a huge impact. Today, we're digging into environmental management accounting, EMA for short. Our mission here is pretty straightforward. Unpack what EMA really means, why it's suddenly so critical for businesses and the planet, and look at the actual tools companies use to manage it.
Exactly. And maybe the first thing to clear up is that we're talking specifically about environmental management accounting, EMA. It's actually a part of the bigger picture, which is environmental accounting overall. But EMA, it really zooms in on the information needed for internal decisions inside a company. Now, that info might get used for external reports too, sure, but its main job, helping managers make better choices internally.
Right. Okay. So like how regular management accounting helps companies track performance and plan ahead, EMA is kind of the environmental specialist version of that, looking at things like energy costs, water waste, that sort of thing. But are we just talking about money here? Or does EMA go beyond the pounds and pence? Because, sometimes the biggest impacts aren't financial, are they?
That's a really key point. And you're spot on. Yes, financial costs are absolutely part of it, a big part. But EMA's real strength, I think, is that it forces you to consider those less obvious non-money things too. Things like, should we buy from suppliers who are more eco-friendly, even if it costs a bit more? What's the benefit there? Or what happens to our reputation, our public image, if we mess up on environmental rules? Those can be huge costs long-term.
Yeah. Okay, let's make this concrete. The gym towel example is pretty good for this, isn't it? So imagine a gym. They use this technique, activity-based costing. We can maybe talk more about that later. But they use it to figure out the real cost of washing towels. And surprise, surprise, they find out people are using loads of towels each visit. Laundry costs are going through the roof. Yeah. So what do? They bring in a new rule. Yeah. You want a second towel? Okay, but it'll cost you a little bit extra.
Right. And that simple change seems small, right? But it kicks off a whole chain of benefits. For the gym, well, fewer towels means less washing. So less energy used, maybe less staff time needed for laundry, and the towels themselves last longer, saves money. And for the environment, less electricity, less water, maybe even less cotton needed over time. Resource conservation. Plus, like you hinted at before, the gym now looks more responsible, environmentally where customers might like that. Could even attract more members, boost revenue. It's a classic win-win, really. All from looking closely at one seemingly small environmental cost.
That really does paint a picture. Okay, so we see the practical value. How have the sort of official bodies defined EMA? You mentioned IFAC, UNDSD. Have their definitions changed over time?
Yeah, they have. And it shows how thinking has evolved. Yeah. So the International Federation of Accountants, IFAC, they had a definition back in 1998. They described EMA as managing both environmental and economic performance by using the right kind of accounting systems. They mentioned things like life cycle costing, full cost accounting, looking at benefits, strategic planning, kind of setting the stage.
Okay, and then the UN. The UNDSD.
Right, the United Nations Division for Sustainable Development. In 2001, they really emphasized that internal decision-making focus we talked about. And they made a really useful distinction, which caught on widely. They talked about two kinds of internal information. First, physical information that's tracking energy, water, materials, waste. Where does it all go? And second, monetary information, the actual costs, earnings, savings related to environmental activities. That distinction was so helpful, IFAC actually adopted it later in 2005. What this really shows, I think, is the shift towards seeing environmental performance not as separate, but as deeply linked to economic success.
Interesting. And didn't Hansen and Mendoza have a slightly different angle back in 99? Something about linking it to quality control?
Yes, that's right. They made a very direct link. They essentially argue that environmental costs often stem from poor quality control, wasted materials, inefficient processes. These are quality issues too. So they suggested reporting environmental costs using a cost of quality framework.
Cost of quality. What does that actually involve?
Think of it like treating pollution or waste as a defect, a failure in the system. They broke it down into 4 types. Let's see. Prevention costs. Money spent trying to stop waste happening in the first place. Detection costs. Things like monitoring, inspections, making sure you're complying with rules. Internal failure costs. It's the cost of waste you've created but haven't released yet. Maybe treating wastewater on site. And external failure costs. These are the big ones usually. Costs after pollution has escaped cleanups, fines, reputational damage. Framing it that way really drives home how environmental problems are often just symptoms of deeper operational issues.
That reframing makes a lot of sense. Okay, so we understand what ENA is, roughly.
Yeah.
Why is it so important right now? You mentioned societal awareness earlier.
Yeah, that's a huge driver. People are just much more aware now, aren't they? Carbon footprints, recycling, it's mainstream conversation. So companies have to be seen as environmentally responsible. It's not just nice to have anymore. It affects who buys from you, who wants to work for you.
And then there's the bottom line, the actual cost.
Oh, absolutely. In some sectors, these costs are just massive. You mentioned oil production. Yeah, environmental costs can easily be over 20% of their operating expenses. When costs get that big, you simply have to manage them carefully. It's basic business survival, not just being green.
Okay, so societal pressure, big financial impacts. What about regulations? The rules of the game seem to be getting tougher with bigger penalties.
Much tougher. And much faster. Environmental laws are popping up or getting stricter all over the world, and the penalties for getting it wrong, well, they're designed to hurt. There was that case in the UK, John Craxford Plant Hire Ltd. They got hit with, what was it, £85,000 in costs and fines? Plus, they had assets worth $1.2 million seized, all for illegally dumping waste and breaking permit rules. It's serious stuff.
Wow, 1.2 million Cs. That's significant.
It is. And it's not just the company on the hook. Increasingly, individual officers, managers, even sometimes junior staff can face prosecution if they knew rules were being broken. Which kind of begs the question, doesn't it? If the stakes are so high, why is managing this stuff still such a challenge? And that brings us to the first big hurdle.
Defining the costs, right. That sounds simple, but what is an environmental cost?
Exactly. It's surprisingly fuzzy. The different organizations, different definitions.
Yeah.
The US EPA, back in '98, talked about 4 types.
Yeah.
You've got your obvious conventional costs, like energy bills, then potentially hidden ones buried in overheads, contingent costs for future stuff like cleanups, and image costs, reputation, stakeholder relations. The UNDSD had a simpler view. Basically, costs you spend to protect the environment and costs of messing up like wasted materials or inefficiency. They aren't really contradictory, these definitions. They just look at it from different angles, but it shows there's no single easy answer.
Okay, so definition is tricky. Then comes challenge number 2, finding these costs and, crucially, linking them to whatever caused them.
Precisely. That's the core problem. So many environmental costs just disappear into the big pot labeled overheads, especially in big companies. Finding them is hard enough. But then you have to allocate them accurately to the specific product line or the specific process that actually generated that cost. Without that link, you can't make smart decisions. Think about, say, a drug company. They need to know for each drug exactly what goes in, what waste comes out, how much energy it uses, the packaging, everything. Only then can they really figure out the true environmental impact and the true cost of making that drug versus another one.
Making the invisible visible, essentially. Okay, so once you've defined, identified, and allocated, then you can actually try to control these costs. Let's talk practical examples. Waste, for instance.
Yeah, waste is a big one. And it's not just paying landfill tax or fines. Those add up. It's the lost land. It's methane from landfill. Real environmental impacts. EMA encourages what's called a mass balance approach. Basically, you bought 100 kilos of stuff, but your product only weighs 80 kilos. Where did the other 20 go? That 20 kilos isn't just waste, it's material you paid for that didn't earn you anything. Finding that lost value drives savings and cuts waste.
And water, too. Businesses often pay twice, don't they? Once to get it, once to get rid of it.
That's right. You buy clean water, then you pay to dispose of the used dirty water. So EMA pushes companies to map out every place water is used. Cooling systems, cleaning, bathrooms, find the leaks, find ways to use less, maybe even recycle water internally. Often you find big savings for very little upfront cost. Same goes for energy, actually. Lots of potential savings there, often just through better habits or fixing inefficiencies, not necessarily huge investments.
Yeah, even simple things.
Right.
Like transport, just buying more fuel-efficient vehicles saves money and cuts emissions. Seems obvious, but maybe not tracked properly.
Could be. And consumables, too. Raw materials are usually tracked, but think about office supplies, like printer toner. Do you toss the whole cartridge or refill it? Refilling saves money and reduces plastic waste. It's these seemingly small things, viewed through an EMA lens, that add up.
Okay, so those are common areas, but what about the specific accounting techniques? You mentioned the UNDSD identified 4 key ones back in 2003. What's the first?
First one is input-outflow analysis. We sort of touched on it with the mass balance idea. It meticulously tracks everything coming into a process: materials, energy, water, and everything coming out: products, waste, emissions. It's based on that simple physics principle. What goes in must go out or be stored somewhere.
So back to the 100-kilogram example. If only 80 kilograms comes out as product, this analysis forces you to stare that missing 20 kilograms right in the face.
Exactly. You have to account for it. Is it scrap? Is it evaporating? Is it just leaky pipes? It forces you to find it, quantify it, and then think about the cost. Makes environmental costs much harder to ignore.
Okay, what's next? Flow cost accounting.
Yeah, flow cost accounting. This one looks at material flows too, but it maps them onto the company's structure like departments or cost centers. It divides the flows into categories: the material itself, the system costs of handling it, like energy, labor, and then delivery or disposal costs. The idea is to make the entire journey of materials transparent, find inefficiencies, and ultimately reduce the total amount of material flowing through the system. Good for the planet, good for our wallet long term.
Makes sense. Then we have activity-based costing, ABC. We mentioned the gym towels.
Right. ABC is all about linking costs to the specific activities that drive them rather than just dumping them into broad overhead categories. So for EMI, it helps separate out costs that are clearly environment-related, maybe running a waste treatment plant, from costs that are environment-driven but might be hidden in general costs, like extra energy used by an inefficient machine. It's great for digging out those hidden environmental expenses.
Got it. And the last one, life cycle costing.
Life cycle costing. This one's pretty comprehensive. It tries to capture all the environmental impacts and costs of a product right across its entire life. Literally, from sourcing the raw materials, cradle, all the way through manufacturing, using it, and then disposing of it or recycling at the grave. So quite a powerful set of tools there, really.
Definitely. It really makes you think, doesn't it? How many businesses might still be operating without even these frameworks, just leaving money on the table and missing chances to reduce their environmental footprint?
Quite a few, I'd suspect.
Well, hopefully this deep dive has given you a much clearer picture of environmental management accounting, what it is and why it matters so much now. Yes, there's some jargon, unavoidable sometimes, but the basic ideas behind it offer really powerful ways to boost efficiency and be better environmental stewards.
Absolutely. The value here is huge. It's about uncovering those hidden costs, yes, but also finding genuine opportunities. Opportunities for savings, for innovation, and for making a positive difference.
So let's bring it back to you, listening right now. What could this mean in your world? Just try thinking with that EMA mindset for a bit. Look at processes around you at home, at work. Where are the hidden costs? Where's the waste, the inefficiency? What small changes driven by understanding those flows and costs better could actually lead to some pretty significant benefits for your own setup and maybe for the wider environment too? Something to mull over.